Hey, Joseph, we got San on the line here. What do you want to ask him?
One of the things that I want to ask you is what are some tips that you can give me for raising capital for a deal?
Fundraising to me, on certainly the equity side for multi, Joseph, Brian, had not been as difficult as I anticipated.
Hmm.
I think a lot of it is in the past 2, 3 years, multifamily has been hot. But even
Hmm.
now, we closed a deal early this year. I'm closing a deal this month. The equity piece actually has been good. We're often oversubscribed. A lot of it's because we put in a lot of our own money. We put in low six figures, sometimes seven figures into a deal. And I'm not the smartest kid in the block, but I think investors and friends know that I'm not dumb. So
Hmm.
if I put in a large amount of money, and often we take the comment, we don't take the pref. So we're last in line to get paid. A lot of times it signals to investors that we've done our homework, we're putting our skin in the game. And so we're able to attract good investors.
Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and inspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We got two amazing people on the line with us today. As our experienced investor today, we got San Eng, and as our aspiring investor, Joseph Harris. Gentlemen, welcome to the show today.
Hey, Brian. Hey, Joseph. Great to be here.
All right. Well,
Thanks for having me, Brian.
absolutely. Absolutely. I know, Joseph, it's been a long time coming. We've been trying to get you on a couple episodes. So glad to finally make the timeline work out for us. That said, as is tradition, our experienced investors up to the plate first. So, San, go ahead and tell us a little bit about yourself.
Great. Okay. Well, I made up a name for myself. I call myself an investorpreneur.
Mm-hmm.
Version 1.0, I was an entrepreneur.
Mm-hmm.
Started half a dozen companies, raised almost $180 million, mainly in technology
Mm-hmm.
and consumer, mostly in Asia and North America. So that's the entrepreneur piece. Second piece is the investor. Have managed money professionally in terms of venture capital, blockchain, private equity, as well as, of course, real estate as 2.0. That 2.0 is mainly managing other people's money, although it's my funds. And then currently I'm living my 3.0, which hopefully is the forever 3.0, which is managing my own and family's money, deploying my own capital using the SkyCain Capital platform.
Nice. Hopefully I get to points where I'm 3.0 as well. That's the ultimate goal. Now,
I
one
thought
thing,
you'd be a 6.0 by now, Brian.
yeah, right. I guess 1.0 for me was a different story. I'm living my 2.0 right now, but definitely want to get there.
Great.
Now, something I noticed, you have a book that you co-authored, The 10 Commandments of Investing. Tell us a little bit about the book, how it came about, and really why you guys wrote it.
It's a book 12 years, maybe even 13 years in the making. I mentioned 1.0, 2.0. So throughout my life, I've been in business investing and an entrepreneur. When I turned 45, I had been living almost 20 years in Shanghai with my family. I decided to take 5 years off. Essentially, I took a 5 year sabbatical. You can call it a midlife crisis, but I like to think of it as 5 year break to really sort of think about the next stages and also think about how I would want to invest my time and money.
Mm-hmm.
Spent quite a bit of time reading and also reviewing notes from the past decade of working with a number of investors. And initially came up with a book called The Investor's Bible.
Mm-hmm.
Joseph, Brian, you guys remember Cliff Notes from back in high school and college?
Yes,
Yeah,
I
so
do. Yes,
yes,
I
sir.
do.
Yes, sir. Okay. So my brother Edmund and I, he was a CEO of an investment bank, a listed company in Hong Kong. So he and I spent about 10 years really working with some amazing investors and also studying. And we essentially did a 2 or 3 page summary of what each investor, Buffett, Dalio, Oliver, and that became the Investor's Bible.
Mm-hmm.
And we were going to publish that book during pre-COVID, but when COVID came, my daughter Ia, which you can see in the backdrop, and my nephew Tim read the book, and they said, "This is great content, but you're never going to sell a book."
Mm-hmm.
So what happened was the book was very thick and technical. It was useful, So we spent the next year or so rewriting the book, which became the 10 Commandments of investing. It's not really Stan or E or Tim's commandments. It's really the 10 commandments that the world's greatest investment wizards use, whether they invest in real estate or blockchain or technology, that made them successful. And so we published that book a year and a half ago. And because my daughter and my nephew made it kind of fun to read, and memorable stories and anecdotes, we end up hitting the Wall Street Journal and USA Today bestseller, which has been fantastic. Yeah.
Wow.
And I'm promoting the book. I don't like to promote, but I'm promoting the book because all the proceeds that we do generate from the book, Brian, we donate to charities, including NGOs or schools that promote financial literacy and teach investing. So it's a nonprofit for us.
Awesome. Awesome. Well, if you're listening and you're interested in the book, I'll put a link to that in the show notes looks like I know it's at least on Amazon. I'll put the link to Amazon in the show notes so anybody can grab it. And just remember, any of the proceeds go to charitable organizations. So I love that you're doing that, by the way, the charitable organization piece.
But yeah, it's sold everywhere. It's in Amazon, Barnes and Nobles. It's in some bookstores. We just found a publisher, and later this year we'll actually be translating to Portuguese as well. And we're still looking for Chinese, Korean, and Spanish. Hopefully next year.
All right. Yeah. Maybe I'll pick up the Portuguese version too. So that's that'll be a fun one. Yeah. My last job in the Marine Corps, I was an international relations officer, and the military actually sent me to learn Portuguese. So I spent 6 months getting paid to learn to speak Portuguese, which is pretty awesome. But
that's great.
Yeah. So don't think I could translate a book yet, but I can definitely read a book in Portuguese. So, well, really cool. I really appreciate that. And, for anybody listening, pick yourself up a copy, 10 Commandments of Investing. Sounds like it's right up my alley. So let's talk a little bit more about what I like to call your big burning why. What's your motivation? What's your why for doing what you do?
There's a Japanese phrase called ikigai. I'm not sure if you've heard of that. I guess the French translation would be raison d'être. In English is reason for being. So what essentially is the why. Okay. And so ikigai is a term from Okinawa, Japan. And you probably know Okinawa is one of the 3 blue zones in the world where they have the most centenarians, people that live the longest. And so when they conduct the interviews, they try to figure out why people live long. And one of the big reasons that Okinawan Japanese, they all have an ikigai. They have a why. So I actually have a tattoo. That's the ikigai symbol. And if you get closer, there's 2 birds, myself and the mom. And my 3 daughters flying, and essentially that shows my ikigai is a family and my daughter. So my why, my mission has been to teach my kids. I want to support my kids to do whatever they want to do. If they want to be a doctor, great. If they want to volunteer for the Peace Corps, great. If they want to be an artist, fantastic. But especially as daughters, I've been really focused on getting all my kids financially literate and to be financially free aggressively, ambitiously by the age of 21. I got a 16, got a 17, and a 19-year-old. The 19-year-old is closing her first real estate deal to help pay for her first year of college. So that's really my big why is I'm learning real estate, I'm learning investing, is how to motivate and pass on some of these skills and knowledge to the kids so that they can also acquire this sooner than later.
All right. I love it. And incidentally, I did spend a little bit of time in Okinawa. It's been, almost 20 years, but spent a couple of years there way back when. So I like that. Well, let's talk about some of the real estate deals you've done, or at least one of them. So if you would please pick your first or your favorite, and let's talk a little bit about it.
Well, I'll give you like a minute journey. I've always done real estate as an appetizer. So 20, 30 years ago, always just bought things here and there, and have never lost money in real estate, even as a side hustle. About 3 years ago, after writing the book, and really I'm following the 10 Commandments, trying to figure out which asset class that I want to invest in, and obviously decided real estate, in particular multifamily. I started 3 years ago to look at multifamily passively, and since done 10 investments passively. They all did well. And I looked at how they structure the deals, how to get the deals. And I said, hey, I could probably learn this pretty quickly myself. And started to, I've done about 10 GP or sold GP for GP deals, as small as $500,000 to as big as 23 million.
Okay.
And so the first syndication, which I think you're in, Brian, I closed, it was a 76 store last February in Clearwater, Tampa. At the time, I had about 1 million assets under management in multifamily. As of today, we're north of 65 million. In terms of the active side, we own more on the passive side as well. And so we're, and the majority of these are in Tampa, where I am today. And it's fun. It's a lot of fun. And,
Yeah, it is a
we're
lot of
looking
fun.
to scale this up. Yeah.
Yeah. Now, what do you like about Tampa?
I mean, everything, right? The macro makes sense. The taxes, the landlord, the growth, the net migration, the diversity of jobs, the relative affordability to other parts of the market, despite obviously having went up quite a bit. It still cash flows. Unlike in New York and Austin, it doesn't cash flow. It still cash flows. I like projects that cash flow. Obviously, it's a nice place to be. I'm in St. Pete today, as I have been, so I enjoy coming here.
Yeah.
Life's too short. I don't want to be in a place where I'm making a lot of money, but I don't enjoy it.
Yeah. Yeah, I like that. And
So-
that's definitely part of it. I mean, I started investing in Columbia, South Carolina, because we enjoyed going there. You know, my wife grew up there, and so we were going there a lot anyway. And so that was part of my philosophy of investing in the Carolinas was we go there a lot, we vacation there, we spend a lot of time there anyway. May as well make that part of our business. And you mentioned that with Tampa and St. Petersburg, you know, they're great areas, and there's a lot of good things to do while you're there. So you might as well enjoy it.
Yeah.
I like that.
Yeah.
That attitude.
Yeah. Life's too short, right?
Yeah, life is short. Yeah, might as well enjoy it. So I love it. I love it. So last question for you, and then we'll bring Joseph on. So what's next?
What's next is, in a sense, 65x in about 15 months, right? $1 million last February to about 65 now. Our deals have performed much better than most of our forecasts in the financials. And so, and again, we're having a great time. So right now, as we speak, we made 4 hires today. I just recently brought on board a full-time CFO, COO, Tony, who joined us about 3 weeks ago. And we are scaling up massively to 15x between now and 2025. So 15x from 65 million would get us to about $1 billion.
$1 billion by
Between now and
2025. So you started,
between now and
how long ago did you
a
start?
year. Last February was our first. Last February, we were at 1 million AUM.
Okay. So
We're
roughly
65.
18 months ago in 2025. So basically, you're trying to get to $1 billion in roughly 4 years. I like that.
Yeah. Got a number of strategies. A second fund is in the works. We've got a couple of joint ventures with a group that has 5,000 doors so that we can tackle larger deals. We are looking to acquire a property management company to help us grow in Florida, because the PM side, AM side is difficult. So all those will be in play this year, and so we can grow. Again, we did 65 times in 18 months. I'm pretty sure we can do 13 times, 15 times in 4 years.
Yeah. Sounds like a great goal. I love it. And it sounds like you're setting up the framework right now, getting all the right people in place and getting ready to just hit that scale button and go.
Yeah, and meeting folks like yourself, Brian and Joseph, I'm sure we'll find a way in the next year or two to do some deals together, right?
Love it. I love that. All right. Well, speaking of Joseph, Joseph, you've been waiting patiently for a little bit right now. So now it's your turn. So welcome, and do us a favor and tell us a little bit about yourself.
Well, my name is Joseph Harris III. I'm originally from Virginia. I now live in Wilmington, North Carolina. Just starting my multifamily journey. I've been studying real estate hardcore now for probably about 2 years. I got a background in wholesaling houses, but I wanted to switch over to multifamily because it's much more lucrative, and I've always been attracted to apartments, and I like mixed-use development. So I actually want to learn about real estate development later on.
Yeah, developments. I actually just recorded a podcast episode with somebody who's specialized in developments, and he made a really, really strong case for it. I think it's the ultimate value add. You know, as long as it's multifamily,
I agree.
I'm all for it. But
I agree. It was an actual report. I actually posted it on LinkedIn. I don't know if you saw it or not, but
mhm,
it was a report that came out in Marcus and Millichap that said that real estate development is at all-time highs right now. The
mhm.
past couple of years since after the pandemic, but even though a lot of development projects are going on, they still can't meet the demand for multifamily units.
Yeah.
There's not enough multifamily units countrywide as a nation as a whole. So yeah, it's definitely room for development.
That makes investing in apartments good for whether you're buying existing or developing. You know, if there's that supply and demand imbalance, prices are going to go up, rents are going to go up. So that bodes well for both sides of the fence, as I see it.
Exactly.
All right, well, Joseph. So let's talk about a little bit about your motivation. You know, what's the reason you're doing this? What's your big burning why?
So my big burning why is my family. So that's probably the most important reason would be my family. Other than the money, I
Mhm.
mean, everybody like the money. So if the money not there, it's not going to attract nobody.
Yep.
But other than the money, you gotta have a why because you will get lazy after you get a certain amount of money.
Mhm.
So, but my why is my wife and my kids.
Mhm.
So, because I got 7 kids total, and I
Mm.
got 4 school-aged children at home, so they
Yeah.
depending on their daddy.
Yeah. Oh, I understand that. I don't have 7 yet, but I don't think I'll ever have 7. We got 5, 3 of them at home. Yeah. Yeah. So understand that. You know, you got to keep keep the kids fed and clothed, and I mean that's huge right there.
Right.
So well, cool. Well, hey Joseph, we got Stan on the line here. What do you want to ask him?
I got about 4 questions that I wrote down since you've been talking. One of the things that I want to ask you is, what are some tips that you can give me for raising capital for a deal?
Mhm.
And I'll let you answer the question, and I'll dig further into that.
All right. Hey, Joseph, you got to promise you one thing, though, okay, brother? 7 kids. You got to teach them how to parent 7 kids at some point.
Yeah.
Because whatever I've done or will do is not
Mhm.
masterminding 7 kids. So kudos to you
Yeah.
I mean, I thought I had to talk with 3 kids, right? Respect, man. Fundraising to me, on certainly the equity side for Joseph, Brian, had not been as difficult as I anticipated.
Mhm.
I think a lot of it is in the past 2-3 years, multifamily has been hot. But even
Mhm.
now, we closed a deal early this year. I'm closing a deal this month. The equity piece actually has been fairly good. We're often oversubscribed. A lot of it's because we put in a lot of our own money, right?
Mhm.
So deals
Okay.
we put in low six figures, sometimes 7 figures into a deal. And I think I'm not the smartest kid on the block, but I think investors and friends know that I'm not dumb. So
Mhm.
if I put in a large amount of money, and often we take the comment, we don't take the pref. So we're last in line to get paid. A lot of times it signals to
Mhm.
investors that we've done our homework, we're putting our skin in the game. And so we're able to attract good investors. Not everybody can do that. It's just that
Mhm.
if I decided to raise money, we don't always do. I want to be sure to signal to my investor partners that we have deep skin in the game.
Mhm.
And we'll be the last to get paid if the project goes wrong.
Yeah.
So I think to me, that's been our biggest success factor. Other than that, as we talked earlier, Joseph, we were picking the right asset class. Multifamily truly is a great asset class. We picked not only Tampa and Florida, we picked certain submarkets within Tampa that are better than Tampa
Mhm.
overall. Right.
Okay.
And then we don't overpay for the assets. So when you just kind of put all those slices together and you can close a project, I think the equity piece becomes easier.
I tend to agree. You know, when you're talking with other people, a lot of it is you have to put yourself out there and you have to start talking about it first. When you look at what gives investors confidence, I remember on the first capital raise I did, the thing that I think was the biggest selling point for a lot of people and maybe brought them onto our side of the fence was the fact that I was also investing into the deal. And I do try to put skin in the game in every single deal that I'm in so that I can come with that position. I think it puts you in a much better position asking for people to invest if you're investing yourself. I would actually rephrase what I just said, and instead of asking people to invest, giving people an investment opportunity. You're giving them an opportunity to invest their capital alongside yours. And I think that's absolutely huge. And probably one of the best keys is make sure you have skin in the game. And another thing that he mentioned that I'll bring out is make sure that you prioritize the investors over yourself, and they'll see that.
Hey, Brian, I love
Thank
that. I think everything you said, I agree with Brian. I think I don't see it as begging for money or asking for money. I see it as, listen, if I underwrite 100 deals and get 2 under contract, and I'm going to put in $250,000 to $1 million more money into it, I'm actually doing, not to sound arrogant, but allowing other partners to come in to co-invest with us. It's an opportunity. It's almost like it's a partnership. It's not one way, it's mutual.
Yeah. We're not asking for a donation. So I think a lot of people at the beginning do. We're asking people to co-invest, and it's, I've got my money in this deal, and it's a numbers thing. So if you looked at 100 deals, put in 2 offers, and you finally get, 1 opportunity, I think there's value there too, because you can just talk to your investors and say, hey, look, I do everything I can to look as many of these deals as possible. And this is definitely, the top 1%. And I believe in it so much that I'm putting X amount of dollars into it. So Joseph, does that answer your question? You got more follow-up on that one?
Well, it does answer my question. It's a very good answer, saying. So I appreciate you for giving me that answer, because I have heard other investors say that they want, at minimum, they want the sponsorship team have about 10% of the investment capital in the deal, 10% or more. So they definitely look at that. What if you just don't have it? Say you found a deal. Maybe you can get partners that come in with you, but you yourself don't have it. But you still need to raise capital for the deal. Because that's the position that I'm in right now. I don't actually have the money to put in the deal right now.
I'll go first on that one. That's a great question. And a lot of people a lot of people are in that situation on their first deal. So as far as skin in the game, how do you have skin in the game is another way to look at it. You can absolutely borrow your partner's credibility. If you're not putting money in the deal yourself, the fact that the general partnership has 10% of the common equity or 10% of the equity involved is something that you should be able to point to and say, hey, look, I don't have my personal money in this, but as a general partnership, we have 10% of the equity. Now, something else to point out is most syndications come with acquisition fees. If you're getting a portion of the general partnership, you're going to be sharing in the acquisition fee. One way to be able to say you have your skin in the game is to take that acquisition fee and put that acquisition fee into the deal as equity. So now instead of getting a $10,000 or a $20,000 check at closing, you put that money into the deal. And now you do have equity. You can talk about that. And make sure you're not misleading anybody, but that is one way that you can have skin in the game. And, maybe you're not investing, the $50,000 minimum, but if you can put 10 or 20,000 in, I think that's going to go a long way to help.
Thank you, Brian.
Let me just give you a live example to illustrate, I think, more or less what Brian just said, Joseph.
Okay.
So we're closing this month our smallest Tampa deal, but to me, our most important Tampa deal is a $2.2 million multi 12 unit on a large 15,000 square foot of land in downtown St. Pete. This deal is my daughter's deal. My daughter started at 17 to learn the business and to underwrite. We made a number of bids. We didn't win. This past May, we spent the entire month of May in Tampa looking at a bunch of deals. She did. I drove her around. She doesn't have a license yet. And we looked at a lot of deals, and she underwrote a bunch, and she picked this one. She has no money, but she rounded up myself, her mom, and a partner, Cindy, in Tampa. So there's 3 other partners. And we will be the 3 partners, not her, she's the 4th partner, will be at least 60-70% of the equity because we like this deal. And then she is in charge of underwriting and raising equity from friends and family. She's doing that. Exactly as Brian said, for the work that she's done in identifying and securing and underwriting the deal, she will get a piece of the acquisition fee, and she'll get a piece of the carry interest that equals about $100,000. And the reason for that is she's starting college tomorrow. She just literally flew to Chicago yesterday. She'll start freshman year tomorrow. And when we exit or refi out of this deal, 100,000 of the profits from this deal will go to pay for her first year of college, plus whatever party money or
Yeah.
spending money she needs.
Yeah. It's going to be
So
a really
she started
expensive
with
school for
yeah.
100,000 to only pay for first year.
Well, yeah, it's 85 plus whatever incidentals, but
Yep.
she will do another deal next summer
Mm-hmm.
without money. But she will do the work, Joseph, right? So it's really no difference. Pretty much what Brian said. Let's say you found a great deal, you do all the work, and you invited Brian to be your partner because you did the work. You know, you don't have to put all the capital. You put a small amount relative to Brian, and you can argue for a piece of acquisition fee as well as the carry interest. Exactly like what my daughter's doing.
Mm-hmm.
Yeah.
Gotcha. Thank you, man. Thank you. That was a good,
Timely
excellent
example.
answer.
Yeah,
A
perfect.
perfect example. Yeah.
Yeah. Well, Joseph, you got more questions?
Yeah, my next question, it seems like there's a lot of syndicators and a lot of deals out there in an industry with a lot of competition, especially it's like certain markets, like the Sun Belt area. A lot of people concentrating in Texas, in Florida, and in Georgia. Those seem like the three main states everybody's focusing on. How do you stay relevant and stay competitive so you don't get left behind?
I think it does matter to pick the right markets, but I think a good GP can make money in any market. Then the question is, how do you stay relevant? The question is really, what is your superpower? You're right. There's a lot of syndicate out there, but if you're the best underwriter, that's fantastic. You can offer your services as underwriter. If you're really good at getting loans and you got relationships with lenders, that is a superpower. That's an immense superpower. That's one of my kryptonite, my areas. I'm not very good at getting loans. I always get bad loans. or it takes me longer than I like to get loans. My equity is better than my debt, but maybe you're a good asset manager. Or maybe for like right now, I'm positioning myself as the Tampa guy. I'm closing my 7th deal since February last year in Tampa. People know me as a Tampa guy. The brokers know me. The banks know me now. It's a team sport, right? So you just got to figure out what you don't like to do, maybe you're weak at, but more importantly, what is the area that you can add value, for example, to me or to Brian?
I definitely agree with that. You know, it's you specialize. This is a game where specialization and niching down is going to pay a lot of dividends. And if you want to be the Tampa guy, I mean, brokers, let me just kind of rephrase something. He said he wants to be the Tampa guy, or he is the Tampa guy. If you're going to a different metro every time you look at a deal, the broker's never going to look at you as a Tampa guy. You're never going to create a deep enough relationship to be able to get, you know, knee or waist deep into a metro like Tampa. You know, you're probably never going to get deep enough into an area to create a relationship enough to where the broker picks up the phone and calls you. So I think there's a certain amount of specialization that you have to do to be able to do well in this industry, especially starting out. You know, starting out, there has to be a value equation or a value proposition in a partnership. And specializing, getting really, really good at one thing is a really, really solid way of getting there.
I mean, just examples of friends that have addressed that question, Joseph. I know somebody who was a professional interior designer, and she's part of my multifamily group. Mm-hmm. That's all she does is she pitches herself as the late GP that comes in to transform properties using her interior design, and she gets invited for that because she's able to generate extra value from that. Fundraising, if you know how to fundraise, I know a guy that he was invited to a $130 million deal. He's a Chinese Canadian, and he has access to Chinese money. I know somebody from Tennessee who I think was a priest or a father, and essentially raised his money from the church relationships. So there are different affinity groups, right? I know a couple of NFL players retire. I've done some deals with them that they raise money from athletes. Yeah. These affinity groups. But you could be an asset manager. You could be, you could just all these things you can do because, again, it's a team sport. If you're going to be buying a $100 million building, there's a lot of things to do.
Thank you for that, Stan. Thank you. That's another excellent answer. Yeah. That definitely answered my question.
Well, Joseph, you got any more questions?
Now, this is about due diligence, the next one. During the due diligence process, I know you do physical due diligence and you got financial due diligence. What are some key things that you look for while doing physical due diligence or financial due diligence?
I'll take it first. So in a nutshell, what I would say is the first thing you're looking for is to validate. Validate everything you do. You're going to make a lot of assumptions during your underwriting that you're not able to pin a value on, or you're making guesses, and you're doing everything you can to make these guesses as accurate as possible, but you want to basically validate all of your assumptions. So if you made an assumption that the rent roll is correct, for example, and they're at 90% occupancy, you want to validate that. Anybody can type in things on their property management software and make it look like there's 90% occupancy, right? But I would say the overall broad brushstroke, what you're doing on due diligence is you're validating every assumption that you made in your underwriting and in putting the deal together. And then I would say the second thing you're doing is you're looking for areas that could be potential problems. So, if I had to dumb it down to two things, you're validating all of your assumptions and you're looking for potential problems.
Great answer. I'm not sure I have much to add to that. Joseph, this is not an area that I'm strong in. So when I'm doing projects, I just bring partners or friends that know me better than I do, whether it's a property manager, to help me make sure that the diligence is correct.
Yeah. And I think that's even where I'm at. I've done due diligence on, I think, 12 properties now. That is still a key. I am still not an expert at sewer lines. I'm still not an expert at foundations, carpentry, engineering, all that other stuff. I think end of the day, when you're doing due diligence, make sure you have that team of people with you that are the experts.
Gotcha. Thank you, Brian.
So. All right. Joseph, you got any other questions on there? We were coming close to the end of time. We probably have time for one more if you got one more.
Yep, I got one more.
Awesome.
So that was perfect because I had 4 questions. So what are some red flags you have came across when doing due diligence on the property?
You want me to take this one or you want this one?
Yeah, go ahead, Brian.
Red flags. There were a lot of red flags, I think, after, that we found that we should have. Okay. One deal, a lot of red flags on this deal. We ended up dropping this one out of contract. It was a $2 million purchase price. It was a 40 unit, and this was 2018 timeframe. You get into some of the units. I mean, you look at the back of the building, and there was some major settling. There were inch-wide gaps in the bricks in some places because the property had settled. And you get into some of the units, and there were a couple of units where, there's a definite spot in the floor where things change directions. You put a pencil on one side, and you had like the Continental Divide going through a couple of the units. You put a marble or a ball down, it rolls one way. On the other side of this line, it goes the other way.
That's a foundation issue, right?
It was a settling issue and a foundation issue. And, when you look at the overall purchase price, I want to say it was a 1.8, maybe a $1.9 million purchase price on a 40 unit. And when we saw that gave us, a lot of concern going into this, and we were probably at the time, on the high end of what we should have paid for that property. But that was one of the big red flags. Basically for us is we realized that it was more than we could handle. It would have been our third acquisition. And at the time, it was more than we could handle. There's probably a lot of experienced people who could look at that and say, yep, no problem. I know how to deal with this. But for us, like I said, I think that was the key is it was more than we knew how to handle. It was more than we were comfortable handling. And I think that's what you're looking for. Those are the red flags you're looking for, things that are more than you can handle.
Gotcha. Thank you, Brian.
All right. San, anything to add to that?
No, I think that's perfect.
Right.
I think Joseph asked some great questions.
Perfect. Sounds good. Well, we're going to wrap things up. So thank you to both of you for coming on today. A lot of value added, very, very great conversations, and appreciate your time today. Last questions for each of you. And San, you get to go first. How can listeners learn more about you?
So we're in most social media. Our website is probably the best place, and it's just Sky 10 Capital. Sky, SKY, 10 just means sky in Chinese. Sky 10, TIN Capital.com. We publish regularly. We have about 12,000 subs now. Investment content, educational content from the book, as well as our own deals. And occasionally we may send some investment opportunities or partnership opportunities. So just, if you're interested, you can just follow us or subscribe to our newsletter.
All right. And is that subscription on that SkyTN website?
Yeah, it'll pop up to
Perfect.
send an email.
Perfect. All right. And Joseph, same question for you. How can listeners learn more about you?
Well, I haven't set up my website yet, but I'm definitely going to set that up real soon. To contact me, probably right now, the best way would be LinkedIn, my LinkedIn profile. Search for my name on LinkedIn, Joseph Harris III, and my profile will come up. Or you can just call my cell phone, call or text me, because I'm always looking to network with anybody out there. So I need to build me a team because I don't have an official team yet. My number is area code 910-789-2190.
219. All right. So we'll have that in the show notes for anybody who wants to reach out to him, LinkedIn profile and your cell phone number. Once again, guys, I appreciate you coming on the show today and hope you guys have a great rest of the day.
Thank you. You too,
Thanks,
Brian.
guys. Thank you.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans yet, you are missing out. So get yourself 30 days free by clicking the link below in the description or go to thetribeoftitans.info and we'll see you there.